Welcome to a deep dive. Today we're ripping through a stack of sources that trace the incredible transformation in how we try to predict and trade stocks.
It really is quite a journey,
Yeah.
from trying to understand the market with, let's say, relatively simple math and theory,
Right.
all the way to these incredibly complex algorithms and AI crunching just massive amounts of data
Yeah.
at unbelievable speeds.
Absolutely. And our mission with this deep dive really is to give you a clear path through that whole evolution. We want to understand those foundational theories, where they maybe fell short in the real world.
Yeah, the limitations.
Exactly. And how this explosion of data and computing power brought machine learning into finance, what the top quant funds are actually doing with these tools now.
And maybe even peek ahead, right?
Sig.
Look at some cutting-edge ideas for the future.
For sure. We've got sources covering the classic academic models, the empirical challenges that showed their limits,
Uh-huh.
the tech shifts that made machine learning possible in this space, insights into how giants like Renaissance Technologies and Two Sigma operate.
Those are big names.
Definitely. And a look at specific modern approaches like Laze Q and even landmark AI developments like AlexNet that kind of paved the way.
So basically, consider this your shortcut to getting up to speed on this fascinating and, frankly, fast-moving world of quantitative finance models.
Okay, let's unpack this stack. Where do
Yeah.
we even start?
Well, you kind of have to start at the beginning, right, with the bedrock ideas. The first real attempts to build a theoretical framework for understanding why asset prices move the way they do.
Right, the classics, like the capital asset pricing model, CAPM, developed by folks like Sharp, Lintner, Mawson back in the 60s.
Exactly. And the core insight of CAPM, which was, pretty revolutionary for its time, was its simplicity. The idea was the expected return of an asset should really only depend on its sensitivity to overall market movements, what they called beta.
So you only get paid for taking market risk, the stuff you can't diversify away.
Pretty much. That was the core idea. But, markets are rarely that simple, are they?
Not really, no.
So researchers started looking for other drivers of return, and that led to the arbitrage pricing theory, or APT, from Stephen Ross in the mid-'70s.
Okay, so APT, that was a step up.
It was, because it allowed for multiple risk factors, not just the single market factor from CAPM. More flexible.
But did it say what those factors were?
That was the catch. APT was more general, but it didn't specify the factors. It left a bit of a practical gap, you could say.
Which is where Fama and French came in.
Exactly, Eugene Fama and Kenneth French. Their work in the 1990s was hugely influential. They took the CAPM framework and added specific, concrete factors that seemed to persistently explain differences in stock returns, beyond just beta.
Like, size and value.
You got it. Famously, they added factors for size, whether a company is small or large, what they called small minus big or SMB, and value, like whether it's a value stock or a growth stock. High minus low, book to market, HML.
And didn't they add more later?
They did. They kept refining it, adding factors for profitability and investment patterns. And others, like Mark Carhart, built on it too, adding momentum to create a four-factor model.
So these multi-factor models gave a richer picture, even if still kind of linear.
Yeah, a more nuanced way to think about what drives returns. Still foundational stuff.
And speaking of foundational, you absolutely have to mention Black's Scholes-Merton, right? BSM for options pricing.
Oh, absolutely. That formula, developed by Fisher Black, Myron Scholes, and Robert Merton, it fundamentally changed the derivatives market. It was a game changer.
How so?
Well, it provided a mathematical way to value options based on things like the stock price, volatility, time, interest rates, under certain, idealized market conditions.
Okay, so you have these powerful, influential models, CAPM, APT, Fama, French, BSM. They give us frameworks for risk, return, pricing. Huge deal at the time.
Totally. Game changers, like you said. And yet, this is where it gets really interesting. When people started testing these models rigorously against real-world market data over decades,
They didn't always hold up so well.
that's putting it mildly, their limitations became, glaringly obvious.
Okay, like what? What were the main problems?
Well, take risk measurement first. Traditional models like CAPM or Markovitz's earlier portfolio theory, they lean really heavily on standard deviation volatility as the main measure of risk.
Right. How much the price bounces around.
Exactly. But what's the fundamental problem with using standard deviation for risk?
It treats big up moves the same as big down moves.
Precisely. It treats upside volatility, prices going up fast, the same as downside volatility, prices crashing. As an investor, you really only care about the risk of losing money, right? The downside.
Yeah, that seems like a major disconnect.
It is. And it led people to develop alternatives, like the Sortino ratio, which only looks at downside deviation, or things like conditional value at risk, CVRR, which tries to estimate your expected loss in the really bad scenarios, often more relevant.
Okay, so risk measurement was one big issue. What else?
Another huge one is the assumptions these models make about how markets actually behave. The Black-Scholes model, for example. It assumes asset prices follow this smooth, predictable path, like a bell curve, and that volatility stays constant.
Which sounds not very realistic.
Not at all. Empirical evidence, going back to, pioneering work by people like Benoit Mandelbrot and Eugene Fama again, shows markets are far from smooth or predictable. Market returns have fat tails.
Meaning extreme events happen way more often than a simple bell curve predicts?
Exactly. Big crashes, big rallies, they happen more frequently. And volatility isn't constant. It clusters. You get periods of high volatility followed by more high volatility, and periods of calm followed by more calm.
So models like Black-Scholes struggle with that reality.
They do, which led to more complex models trying to fix it, like Heston's stochastic volatility model or Merton's jump diffusion model, trying to account for sudden jumps and changing vol.
Got it. And what about the factor models like Fama-French?
Challenges there, too. First, you have to actually pick which factors matter. And finding factors that are consistently predictive across different markets, different time periods, that's incredibly hard.
You could just be finding patterns in old data that won't repeat, right? Data mining.
Absolutely. Huge risk of data mining, finding spurious correlations. And these models are typically linear. They assume relationships are simple, straight lines.
But markets aren't always linear.
Rarely. Factors interact in complex, nonlinear ways. And relationships can totally change depending on the market regime. Like a factor might work well in a bull market but fall apart in a crash. Linear models struggle to adapt to that.
Okay, so these foundational theories, while crucial stepping stones, had some pretty significant cracks when faced with the messy, complex reality of markets.
Right. And this kind of created a vacuum, you could say, a need for tools that could handle that complexity better.
Which is where the machines come in. The rise of machine learning.
Precisely. The need for models that could handle more data, capture nonlinear relationships, and potentially adapt to changing conditions. It perfectly coincided with major technological advancements.
Like, just the sheer amount of data becoming available. Things like ImageNet. Wasn't that originally for pictures?
It was. ImageNet, built by Fei-Fei Li and her team, was this massive database of labeled images. It was crucial for training complex visual recognition models, but it showed the power of large, curated data sets for AI in general.
And computing power took off too, right? GPUs?
Exactly. Graphics processing units. They turned out to be fantastic for the kind of parallel calculations needed for deep learning. Think about the landmark 2012 paper on AlexNet.
AlexNet. That was a big deal.
Huge deal. Alex Krzyzewski and Jeffrey Hinton used GPUs specifically because training that deep convolutional neural network on ImageNet was incredibly computationally expensive. And it absolutely smashed the benchmarks for image classification.
So it showed the world what deep learning could really do.
It really did. It signaled that AI capabilities were reaching a whole new level, moving beyond theory into powerful, practical applications.
And finance quickly saw the potential.
You bet. With bigger data sets available, not just price data, but news, sentiment, economic data, all sorts, plus faster hardware like GPUs and more sophisticated algorithms, machine learning became a viable, even essential, tool for finance.
Because ML models could potentially find patterns that the older formula-based models just couldn't see.
Right. They can handle high-dimensional data, find subtle nonlinear connections, and potentially adapt as market relationships shift over time. That's the promise, anyway.
So what specific types of ML models are we seeing used in trading now?
Well, for dealing with structured, tabular data, rows and columns of features, you see a lot of random forests and gradient-boosted trees. Things like XGBoost, LightGBM are very popular.
What are they good at?
They're great for classification and regression tasks. And they're known for being able to find nonlinear relationships without you having to explicitly program them in. Pretty powerful off-the-shelf tools.
Okay, and for time series data, like price movements over time.
There you see things like LSTM's long short-term memory networks. They're a type of recurrent neural network, or RNN.
And they're good because they can.
Let's remember.
Essentially, yes. They have internal memory mechanisms that allow them to capture temporal dependencies, how past events influence future ones, which is obviously critical in financial markets.
Makes sense.
Any others?
Well, even CNN's convolutional neural networks, the kind AlexNet used for images people are experimenting with them, maybe for finding visual patterns in price charts or other representations of market data. And reinforcement learning, RL, is being used too.
RL, how does that work in trading?
You basically train an algorithm to learn an optimal trading strategy by letting it interact with the simulated market environment. It learns through trial and error, getting rewards for profitable actions and penalties for losses.
Okay, so lots of different ML tools. The advantages seem clear. Handle complexity, use more data, adapt.
Compelling pros, definitely.
Yeah.
But the cons are significant too, and you really need to be aware of them.
Like what?
Well, first, they are incredibly data hungry. You need huge amounts of high-quality, clean data to train them effectively. Garbage data in, garbage predictions out.
Okay. And the black box problem.
That's a big one. Many complex ML models, especially deep learning ones, are essentially black boxes. It can be very difficult, sometimes almost impossible, to understand why the model made a specific trading decision.
And if you don't know why it works, it's hard to know when it might stop working.
Exactly. It makes risk management really challenging. How do you anticipate failure modes if you don't understand the reasoning? They're also prone to overfitting.
Meaning they learn the noise in the training data, not the real signal.
Right. They might look great on historical data, but fail miserably out of sample in live trading. You need very careful validation techniques.
And they can be fragile if the market suddenly changes in a way they've never seen before.
Definitely. Sudden regime shifts, unprecedented events. If it wasn't in the training data, the model might react unpredictably or just break down.
Which leads us to hybrid models, combining the old and the new.
Yeah, that's a really strong trend. Hybrid models try to get the best of both worlds. You might take theoretically sound factors, like from Fama French, or well-established technical indicators.
Things that have some economic logic behind them.
Exactly. And use those as carefully chosen inputs or features within a more powerful ML framework, like a gradient-boosted tree or a neural network.
So you guide the ML with some domain knowledge, but let it find the complex patterns.
That's the idea. Leverage economic intuition and some interpretability from the traditional side, but use the ML's power to find nonlinearities in interactions that a simpler model would miss. It's a pragmatic blend.
And this isn't just theory, right? These are the techniques powering the biggest quant funds.
Absolutely. This is where the rubber meets the road. Look at the pioneers and the current giants. Renaissance Technologies, founded by Jim Simons. Their Medallion Fund is legendary.
Weren't they super early adopters of this stuff?
Decades ago, reportedly. They were among the first to really apply sophisticated statistical and mathematical methods at scale, likely incorporating ML-like techniques long before it was mainstream.
And they're known for StatArb, HFT?
Statistical arbitrage, high-frequency trading, yeah. Basically finding and exploiting tiny, short-lived patterns, aggregating signals across thousands of instruments. Their performance, medallions like 39% annualized net returns over decades.
Yeah.
It's just incredible, unmatched.
But you can't invest in Medallion anymore, right?
Nope. Famously closed to outside investors for years now. Capacity constraints, they say.
Okay, who else? 2 Sigma?
2 Sigma, founded by David Siegel and John Overdeck. They're a great example of a modern, heavily ML-driven quant fund. They explicitly use techniques like XGBoost, deep learning, random forests on massive datasets, including lots of alternative data.
I heard they even run competitions like Kaggle to find new algorithms.
They do. They really embrace that data science ML-forward approach. Maybe more exposed to broad market swings than Medallion's market-neutral style, some sources suggest, but definitely at the forefront of applying modern ML.
Any other big names?
You've got D.E. Shaw, another giant, known for broad systematic strategies across many asset classes, and WorldQuant, spun out of Millennium, famous for its massive alpha factory approach, generating literally millions of potential trading signals, often using ML classification methods.
So the takeaway is these top firms aren't just using one magic model.
Not at all. Their edge comes from combining many different techniques, layers of models, proprietary data, sophisticated infrastructure, and constant research and refinement. It's a whole ecosystem.
Do we have any insight into the specific techniques, the sort of secret sauce they might use?
Well, the sources give us some glimpses, some recurring themes beyond just use ML.
Like what?
Okay, one example mentioned is using the Baum-Welch algorithm, often within something called hidden Markov models, or HMMs.
HMMs. What are those used for? Not just predicting the next price tick.
Not necessarily directly. It's more about trying to figure out the underlying hidden state or regime the market is currently in.
Like, is it a bull market, bear market, choppy sideways, high vol, low vol, that kind of thing?
Exactly. If you can estimate the current regime, you can adapt your strategy. Maybe certain signals work better in rending markets, others in range-bound ones. Maybe you adjust your position sizes based on volatility. HMMs help model those hidden dynamics.
Okay, that makes sense. What else? High-frequency trading, HFT.
Definitely a big part for some, like Renaissance. HFT is all about speed, executing trades in microseconds or milliseconds to capture tiny fleeting price differences, maybe between exchanges, or tiny bid-ask spreads.
So it's an infrastructure and speed game?
Hugely. Massive investment in fast networks, co-located servers, and models that can react almost instantly, exploiting micro-inefficiencies that disappear in the blink of an eye.
Then there's the idea of using lots of signals.
Yeah, diverse signal arrays. A signal is just anything that might have some predictive power. Could be a simple technical indicator like RSI. Could be sentiment from news articles. Could be some complex pattern derived from order book data. Top funds use thousands of these potential signals.
But aren't most individual signals pretty weak?
Often, yes. Very weak on their own. The real edge comes from how they combine these diverse signals. They use sophisticated aggregation models, often ML-based, to intelligently weigh and blend these thousands of weak predictors into a single, stronger, more robust overall forecast or trading strategy.
So diversity's key. Don't put all your eggs in one signal basket.
Exactly. It makes the strategy less reliant on any single input and hopefully more robust across different market conditions.
And finally, something called the Kelly criterion for position sizing.
Right. This is a really important concept, often overlooked. It's not just about finding good trades. It's about knowing how much to bet on them. The Kelly criterion is a mathematical formula that helps determine the optimal fraction of your capital to allocate to a trade based on its perceived edge, how much you expect to win, and the probability of winning.
So it balances potential profit with the risk of ruin.
Precisely. It aims to maximize long-term portfolio growth while managing risk. Bet too little, you grow slowly. Bet too much, you risk blowing up. Medallion is famously reported to use a modified version of Kelly to size positions across their aggregated signals.
Okay, so combining regime detection like HMM, speed like HFT, diverse signals, and smart sizing like Kelly, that starts to paint a picture of how these funds operate.
Yeah, it's a multi-layered, complex process.
Yeah.
Which naturally leads us to think about, well, where is this all heading? What's the future look like?
The trend seems pretty clear. More complex, more data-driven, more adaptive models.
Definitely. Hybridization, combining different models, different data sources, maybe traditional factors with ML overlays, it seems key.
And AI and machine learning will just get bigger, right? Exploring even more data, finding even more subtle patterns.
Seems inevitable. But as we talked about, that black box problem isn't going away easily. Investors and regulators, too, often want transparency. They want to understand the why.
Which brings us to Laze Q, mentioned in our sources. They seem to be tackling that intersection.
Yes, Laze Q is presented as operating right at this cutting edge. Their core idea is something they call Symbiotic Quant Intelligence, or SQI.
Symbiotic, meaning humans and AI working together.
That's the pitch. It's framed not as AI replacing human experts, but as a blend, a partnership. They talk about a symbiotic learning loop, where human experts curate data, provide feedback, inject domain knowledge, and an algorithmic discovery engine where the AI then explores, tests, and refines strategies based on that human-guided input.
So, trying to combine human intuition and experience with the AI's computational power.
That seems to be the goal. And they position this approach as a way to tackle common investor problems, things like emotional decision-making, getting overwhelmed by information, timing markets poorly. The aim is what they call refined peace-of-mind investing.
Peace of mind is interesting. Does that relate to the black box problem?
It seems to. A key part of their message is focusing on explainable AI, or XAI. The goal is for the investment decisions to be understandable, for the investor to get the why behind the strategy. That directly addresses one of the big weaknesses of purely black box ML models.
So Laze Q is kind of an example of where things might be headed using advanced AI, but in collaboration with humans, aiming for performance, risk management, and transparency.
Yeah, it represents one promising direction, trying to harness the power while mitigating some of the key challenges, potentially making sophisticated strategies more accessible or at least understandable.
Wow. Okay, we have really covered a lot of ground here. We started with those classic theories, CAPM, Fama French, Black Scholes, built on relatively simple math but powerful ideas.
Then we saw how their limitations, when tested against messy reality, pushed the field forward. The need to account for fat tails, changing volatility, multiple factors.
Which paved the way for the era of big data, fast computers, and the rise of machine learning tools like random forests, LSTMs, used by the giant quant funds like RenTech and 2 Sigma.
And we got a glimpse into some of their potential techniques understanding market regimes with HMMs, the sheer speed of HFT, the power of combining thousands of diverse signals, and the critical importance of position sizing with things like the Kelly criterion.
And finally, looking ahead, seeing how new approaches like Laze's Symbiotic Quant Intelligence are trying to blend that human expertise with AI power, aiming for potentially better, maybe more understandable investing outcomes through things like explainable AI.
Thinking back on everything we've unpacked, what's the one thing that really stands out to you from this deep dive?
That's a good question. For me, maybe it's the constant tension between complexity and understandability, but here's a provocative thought to leave everyone with. Given that even the most sophisticated AI models, the ones used by the absolute elite quant funds, still apparently need continuous human oversight, still wrestle with market shifts they haven't seen before, and still face these real challenges with interpretability. What does peace of mind investing truly mean for you, the individual investor, trying to navigate this increasingly complex, algorithmically driven world? Something to think about.